Thank you very much. Thank you everyone for attending, and thank you everyone who's listening in online. It's my pleasure to provide an update on Heliostar, to talk through the progress that we've made over the last 12 months and to lay out the plans to become a much larger scale mid-tier gold producer with significant margin. I note that we're making forward-looking statements. You'll be able to find this presentation on the website and read through in more detail. I've started this presentation with a slide that you're seeing a little bit about the industry at the moment, which is the incredible margin expansion that gold producers are seeing today. For us, you can use the Colorada mine as an excellent example of that margin for a Heliostar particularly. In blue is the all-in sustaining costs since the mine started in 2014, and you see a long period of around $200 to $400 margin, and you see this incredible expansion right now over the last couple of years that we're enjoying. I think the read-through to that is if you're a steady state producer, that's going to be great cash flow for a number of quarters, hopefully a number of years. If you want to know the companies that it really benefits the most, it's producers that are scaling up production. Because in our example, it allows us to move more things quickly with the free cash flow that we're generating, and it means less dilution for that bigger production scenario. So this run up in gold price, I believe, is having a bigger impact on growth producers than any other group, developers or steady state producers. It's been our long-held ambition since we founded the company to grow to be a 500,000 ounce a year producer by the end of the decade. We think we can get to 300,000 of those organically with the pipeline that we have today. Sorry, I was just checking the clock so I can keep the time moving. Our portfolio today is made up of 2 operating mines and 3 key development projects, the peak of which is our Paula project. We bought these assets in very distressed circumstances last year. We were able to invest significantly in those assets, and they've led quite a remarkable turnaround for Heliostar as a company. We restarted the Colorada mine at the beginning of this year. We're going to restart the San Agustin mine in Q4 this year, and we think we can generate over the next 2 years between 100 and 150 million in free cash flow from these assets. We want to use that to build Paula. In terms of where our portfolio is, our operating mines are in Sonora and Durango. For those who aren't familiar with Mexico, be the equivalent of being in Nevada and Arizona in the US. Our 2 development projects are in Guanajuato and Guerrero. We have 3.2 million M&I ounces, another 2.9 we currently treat as historic. By the end of Q4, we'll be able to merge those numbers together, and we've got a really strong resource base to grow the company from. This is a combination of our production profile from our existing assets and things that we forecast to bring online. So I note that anything here in a dashed line is an internal estimate of what we would like to bring online. It's going to require production decisions permits, whereas the hard lines are supported by technical reports we have out there. At the moment, Heliostar is producing 30 to 40,000 ounces of gold this year at high margins. We anticipate growing that to 50 to 60,000 ounces over the coming couple of years. And our big step change comes when we bring Paula online in 2028. We think we can move to 150 to 200,000 ounce a year run rate at a below $1,500 all-in sustaining cost. If you want to know our value proposition in a phrase, if you look at 150 plus thousand ounce producers at sub 1,500 AISCs, we can't find one below 2 billion market cap. If we do what we say we can do, that's a 4 to 5x from our market cap today, and more importantly, we think we can get there with little to no equity dilution. We think half of the cost of building Paula can come from the free cash flow that I referenced, and the other half from a project financing facility. That's what we believe will separate us from most of our peer performers. We think we can grow, and we think we can grow on a per share basis. If you look at our corporate structure, we began September with just under a 400 million market cap Canadian. We're just over 400 million today. We've got 30 million cash, no debt. We've got a significant number of warrants held by our largest shareholders coming in. We're just over 250 million shares outstanding and 300 fully diluted. We've got a very healthy treasury, and it's growing every month on the free cash flow of our operating assets. We're supported by some very large shareholders. We started the big raise to acquire these assets in January 2023. We closed it in March. The perverse benefit of tough times to raise money is you get really strong shareholders. Some of our leading shareholders include Eric Sprott, Franklin Templeton, and Adrian Day's Europac Fund. The team is run by myself, a geology background, big company background, fortunate to have experience in Mexico, also was able to lead a significant discovery for Vizsla Silver. Our team's got experience at Gatos, at Capstone, at Newmont, at Newcrest, at First Majestic. We've done individually all the things that we aim to do as a company over the next couple of years. We aim to do it now as Heliostar. As I touched on, our guidance is 30 to 40,000 ounces this year. Our all-in sustaining costs, we're averaging around $2,000, but I note that that's quite lumpy when you break it down by line item. We're a relatively low-cost producer in Q1, Q2, and Q3 this year. We restart San Agustin in Q4, so that becomes a high-cost month with the restart, a high-cost quarter, with the restart of San Agustin, and then we expect to return to being low-cost, around 1,800 in for the remainder of 2026 onwards. Q2 was forecast to be our weakest quarter. We'd restarted La Colorada, but we only started to see the gold flow out of the leach pads midway through the quarter, and San Agustin's producing less and less and less until we restart. However, we still had a $1,540 all-in sustaining cost, mine operating earnings of over $14 million. We grew our working capital to over $50 million. We're very well positioned, and that's the positivity of this gold price move has meant we thought originally we might need an equity piece after we closed the transaction. We found gold production at La Colorada. We thought we might need large project financings to cut back the pit at La Colorada. We've been able to sequence that, so we only needed small cash steps. We thought we might need small project financing steps, but the production has built up our treasury to the point that we can fund all the plans that I'm laying out from our operating cash flow. That means less dilution. That's what the power of this gold price is doing for nascent growth companies like Heliostar. And so if we look through those assets, I think this is a lovely way to start and talk about our La Colorada mine. It was one of Eldorado's first two mines in the 90s. It built Argonaut in the 2010s, and I think it's going to build a third company over the next decade. We've taken this from care and maintenance to a 6.5-year mine life in only 6 months. The big opportunity that's changed for us, you see here in gold, these were waste dumps put there as material that had to be moved in the 90s. We're making more money out of the waste dumps than Eldorado made producing the ore in the 90s. That's how far the gold price has moved. We're going to see no CapEx production out of those this year and next year, and then we're going to use that cash flow to expand the pits. We're putting an updated technical report out in the next couple of weeks. We believe that you can, when you see the CapEx number that's going to come for stripping at Veta Madre, just plug in the Eldorado stockpile, which we've just finished drilling now. So we're going to move from stockpiles to Veta Madre to the Creston pit, and instead of needing that large CapEx number to cut back the Creston pit, we think we can get there, as I foresaw, with very little CapEx, which is an incredible turnaround for La Colorada. It allows us to then focus on what the upside of La Colorada might be. We think there's potential for a larger pit, what we call Veta Madre Pass, that would have another up to 30,000 ounces with a bit of confirmation drilling. We've drilled some incredibly high-grade holes under the pits, 5 to 10 metres at 5 to 25 grams per tonne gold. We think there's underground potential above and beyond the immediate mine life in the current technical report. We also can then pivot to upside. It's incredible for an asset that's been in production for as long as La Colorada has. It's about 2.5 million ounces, mined history plus resources and reserves. It's turning into a significant district, but there's very, very little drilling out of the key mine trend. To really labour that point, you can see this soils target, a 2.5 kilometre long gold in soils anomaly above the cut-off grade of the pit, and it's never been drilled. we're really excited about the exploration potential above and beyond the technical report that we're going to put out at La Colorada. If I move to San Agustin, so right now we're getting gold from residual leaching at San Agustin. We received all of the permits and permissions in late June to restart and expand the open pit at San Agustin. We made that decision to proceed, and we expect to be crushing and stacking in October for first gold production from what we call the corner area, which is well shown on this graphic here, in early December this year. It was an area that the previous operators didn't get the surface rights to until 2022. Then you had the AMLO government not handing out permits. We've been able to receive that, and so it's an excellent growth opportunity. At $3,000 gold, we expect to make $40 million next year from San Agustin. If gold price stays at these levels, we're going to make significantly more. We had the discipline that we were not going to invest in San Agustin until we knew we could get permits to expand production. Now that we have those, we're committing to a 10 to 15,000 metre drill program, looking to grow predominantly the oxide footprint of the deposit to try and extend the mine life at San Agustin. There is also a significant sulfide endowment underneath. It's a body with analogues to Penasquito or Camino Rojo, so we will do some true exploration drilling as well, looking for higher grade sulfides that might be another longer mine life opportunity at San Agustin. Together, to repeat, with over 50,000 metres of drilling, with significant spends on Ana Paula, which I'm about to talk about, we still believe that we can generate between 100 and 150 million of net free cash flow over the next 2 years. The idea is to spend that to build Ana Paula. Ana Paula is a project that's sold for over $100 million. It's had over $100 million invested in it by previous operators. It's permitted for an open pit mine. It's probably going to save us between 50 and 100 million in our capex on infrastructure that's already there, including this decline here. We completely changed the scope of the project when we bought it. We thought that it makes much more sense and is much more capital efficient as a high-grade underground. And the reason we did that is you can think of Ana Paula as this giant sea of low-grade with this spectacular high-grade core in the middle. The high-grade panel is over 100 metres tall, 280 metres long, and 60 metres wide, averaging 5 grams per tonne. We've got an over 700,000 ounce M&I resource at 6.6 grams per tonne, and another 450,000 ounces at 4.2. The reason for such a large inferred is we were taking an open pit resource underground, and we didn't have the financial capacity to do all the drilling we wanted. That's changed, and now we're drilling a 15,000 metre program focused on conversion of those ounces to go into our feasibility study. We put the first set of those results out in late August, 30 metres at 6, 20 metres at 6, 15 metres at 13 grams. Ana Paula is a uniquely high-grade, disseminated bulk underground mine opportunity. And when you read through that, what that means to me, that means the potential to be a very high-margin project. We're going to have continued news flow from that program over the next 6 months. We're likely to increase the number of rigs doing that work very shortly. We see a lot of potential to continue to expand the footprint of the high-grade panel. What we're doing as a study right now is completing the feasibility for that mine design. We're anticipating somewhere up to a $300 million capex for Ana Paula. We've just finalised the flow sheet. We're going to do something in the order of a 1,500 to 2,000 tonne per day plant. We're going to go into flotation and CIL. The bulk of the high-grade panel has 80% recovery. There is a part of the ore body that, though, is refractory, and so we're likely to put a small BIOX plant. About 50 million of that 300 million number would go to a BIOX plant that would give us 90% recovery of the refractory part of the ore body. The economics are driven by the free milling part of Ana Paula. We think we could have gravity recoveries as high as 30 to 40% out of the deposit, and then we can get a longer mine life by processing some of the material that we wouldn't have been able to get without that BIOX circuit. We're just finalising what the tailings design looks like. That's going to finalise the permit submission to change from the open pit to underground. We expect to have the permit back by late next year to have completed the feasibility study on that larger resource, we're targeting a 10-year mine life at 100,000 ounces of production, and we aim to have the financing package put together so we can build Ana Paula in 2027 for commercial production in 2028. With the cash that we're generating, we would also like to complete the decline that stopped when a previous owner had another mine that started losing money for a company called Alio, for those who know. So we intend next year to push the decline into the ore body, to de-risk the feasibility study, to demonstrate that we can bulk underground mine the deposit, but also to use it as a platform for the deeper drilling. There's deeper zones in Ana Paula, like 13 metres at an ounce, 40 metres at 6 grams. We need that platform in to do that deeper drilling. The reason why we're excited about the deeper drilling is we're in a part of the world that creates very big gold ore bodies. We think that we're geologically more shallow than Torex's Morelos complex in Los Filos. We think that there will be a causative intrusion and a contact skarn deeper under Ana Paula. Top right is a 20 million ounce deposit, mined history, production, and resources and reserves. Morelos complex, 15 million ounces in that category. We think there's the potential, we're very confident that we're going to have an incredibly high margin mine at Ana Paula. We think there's the potential that we could also have a tier 1 project if we have some success with the drill bit. We think we might be able to have an all-in sustaining cost around $1,000 an ounce. If you use round numbers, say $3,000 an ounce gold price, 100,000 ounces a year, we might be able to generate $200 million a year in free cash flow. That's over half our market cap today in free cash flow from one asset. We think Ana Paula might be able to produce more cash flow than most 200,000 ounce a year producing mines. And we think that comes from the bulk underground mining, the grades of the deposit. We think that's really trying to reinforce the margins that we believe that we can drive on Ana Paula. Beyond Ana Paula, we're going to update the Serra de Gaia PFS in Q4 this year. We think there's no value in our company for this asset. We plan to build it after Ana Paula with the cash flow of Ana Paula. It's a historic resource of 2.9 million ounces at 0.5 grams per tonne. We think it's going to show very attractive economics in the current gold price environment. We think it gives us that organic pipeline to repeat to 300,000 ounces. I've left this slide up. We'll probably move away from it going forward, but this is the slide that we put up when we first bought these assets of what we plan to do. And so what I'm very proud of what our team has done is that we have delivered on all of the key deliverables that we promised. We were truly a trust me story last year when we bought these assets. We said we had lots of optionality and we were trying to find the best way to unlock it. Now we're delivering certainty on the production plans for our operating mines. And I kind of like our news flow forward to think of it in 3 levels. There is that steady state quarter in, quarter out production showing that these are very profitable mines that are driving free cash flow. We've got these big NAV growth steps in front of us, the updated La Colorada technical report, the PFS for Serra de Gaia, and the feasibility study for Ana Paula. And then we've got the 40 to 50,000 metres of drilling that we're doing at the moment that can grow resources and potentially provide exploration success. If we do what we've laid out in this plan, if we can grow to 150 to 200,000 ounces, if we can do it without any material equity issuance, we think we can provide an outperformance share return that most of our peer group and most of the major producers in this gold cycle. Thank you.